Hi guys, Max here, and this is your daily market update for yesterday, the 18th of July. And as you can see, American equities in particular really didn't perform too well. The energy sector was okay, with most oil companies rising by 2 or 3% for the day, but pretty much everything else was down, with healthcare performing particularly poor and big tech not exactly doing well. The S&P 500 then fell by 0.8% for the day, and the Nasdaq fell by 0.9%, the Dow Jones was down by 0.7%, and the Russell 2000 fell by 0.3%. As for the rest of the world though, it was actually rather more positive. The rest of the Americas performed quite well, Europe was up, although it wasn't exactly an easy day, and then China boomed by quite a lot, with some incredibly volatile markets as we're getting used to over in the Asian markets. The FTSE 100 and the Stock 600 both rose by 0.9%, and so on the whole, the MSCI World Index didn't really change much for the day. Now, in the world of foreign exchange, well, the dollar actually weakened slightly for the day, down by about 0.4% against an index of its peers. The euro rose by 0.6% and is now at $1.01 above the value of the dollar again, although it did briefly dip down to 99 cents to $1. The pound was up almost by 1% and is back to $1.20, and the yen rose very slightly as well, but that's still sitting very weak at 138 yen per dollar. As for fixed income assets and the bond market, well, yields rose across the board with prices falling. The US 10-year Treasury yield rose by 5 basis points and sits just below 3% at 2.97, and it's gotten pretty used to that level over recent weeks. We saw the German 10-year yield rise by 8 basis points and the British by 7 basis points as well. So investors leaving both risk on and risk off assets for the most part. In the world of oil, well, oil prices rose on basically the news that Biden's delegation, his trip to Saudi Arabia, failed, to be honest. I covered this in a full video yesterday, so go check that out if you missed it. But basically, we're not going to see any more supply of oil from Saudi Arabia, so WTI crude oil rose by about 5% for the day and is at $102 a barrel, and Brent crude is sitting higher at $106. Finally then, for traditional financial markets, gold prices are still sitting comparatively very low at $1,710 an ounce. Now, what happened in the crypto markets? Well, it was very surprising because the crypto markets rose over the weekend. Now, it doesn't look like it rose by a lot because it says that Bitcoin's only up by 0.6%, but actually it was sitting far below $22,000 when we left off on Friday, and Ethereum is still up 5% from the last day alone, so most crypto assets did actually rise for the day. Now, was there any really strong news to drive this market growth? Well, not really. We got some new developments regarding a couple different bankruptcies which are still continuing, so the situation within crypto isn't actually any better. The Three Arrows Capital collapse is still progressing. Celsius sent out a new update and went to court over their bankruptcy, and they basically said that their clients have no legal right to the crypto that they gave Celsius, so they want to keep it all. So in my opinion, there isn't actually much good news coming out of the crypto markets, but we will put out a full video on this topic later today. Moving on to corporate earnings then, and we have quite a bit to talk about. Starting off with IBM, who put out their earnings and their share price fell by 4% after hours on this news. So was it a really bad earnings report? Well, actually not really. It was pretty solid. They saw 9% revenue growth over the last quarter and 80% earnings growth over the last year, which is really strong. And both of those were far higher than analysts were expecting as well. So why did IBM's share price fall on this good news? Well, they left the Russian market last quarter for good, which was very profitable for them, and they'll never get that revenue or those profits back. They're also seeing a lot of wage inflation for their employees. They're having to compete for talent, and that's getting more expensive. And as they're mostly a consulting firm at this point, they have an awful lot of manpower. They're also very worried about the recession that's coming and how that will impact their business and then inflation into the future as well. And so they're putting out caveats about future performance too. Basically, they had a decent earnings, but the stock still fell in value anyway, which is a very common thing that we're seeing in 2022 so far. We also got some earnings from some big finance giants, starting off with Bank of America, who saw their share price rise by 0.1% on their earnings report. So as you can imagine, it wasn't an awful report, but it wasn't exactly stellar either. Their profit was down by 32%, but that was expected and pretty much in line with what analysts had priced into the market. Revenue was up by 6%, which was actually a bit of a surprise to the upside, so that's quite nice to see. They say that their customers are spending more on services and less on goods, but on the whole, they are still spending more, and so there's more revenue for them to make off their customers. But there's also this slowdown in the housing market and the mortgage market in particular, which is going to impact financial firms' earnings into the future too. Another massive finance titan, we have Goldman Sachs, and they came out with their earnings, and it was actually really quite strong, or at least a lot stronger than was priced into the markets, and so their share price actually rose by 2.6% for the day. Now their profit was actually down by about 48%, but that's better than was priced into the markets. That's better than analysts expected. Revenue was down by 23%, but that's actually way better than we were expecting, and so the markets liked this news. They're also seeing a bit of an impact of the slowing economy and the mortgage market, and in particular there are far less IPOs, far less private funding deals going around and things like that, and so there's less money to be made by these banks for that reason. And of course they're also worried for the future, putting out news that Goldman Sachs are going to be slowing their hiring as they go forward into 2022, and they're also going to be reducing their bonuses too. Now, on the news of slowing hiring for a day in response to a poor economic outlook, we got the exact same news coming from both Google and Apple, who are also going to be reducing the amount of people they're hiring and also reducing the spending on research and development and things like that as we go forward. Now, why are they doing this? Well, because they're worried about the economy, basically. Both stocks are down about 2% over the last day on this news in particular, and so investors are a little bit worried about what this might mean for big tech companies, the companies which really are the most resilient in the world to a recession, and why they're getting worried about this recession. Of course, they're both massive bellwethers for the market. Something as simple as how many orders Apple are putting for iPhones for a year is seen as an indicator for whether or not the economy is going to grow that year. And so this news is worrying a little bit. Of course, though, this trend is seen across almost every single tech company over this year so far. The idea that tech companies need to accept lower growth into the future and they need to, slow down on hiring and be a bit more financially responsible isn't exactly news. For most of these companies, though, it's to stave off bankruptcy. For Apple and Google, though, it's just to be a bit more responsible. They are in pretty much no risk whatsoever of actually going under. They're just being safe. Now, moving on to the private markets, and we have some bad news out from Instacart, who've seen their valuation drop by 62% in private markets over not even 1 year. Back in late 2021, they were valued at about $40 billion. Back in March, they were valued at $24 billion, and then today, they're now valued at under $15 billion. Now again, this is the same kind of thing that's seen with every tech company, any company that's working in a new industry and trying to carve out a niche for itself. Instacart really aren't that groundbreaking a company. They pretty much just give people food quickly. They send someone to a supermarket and they shop for you and then they bring it to you. This really isn't anything groundbreaking, it isn't innovative, and it's not actually a service that many people really need and are willing to pay for. It's not exactly a surprise, in my opinion, then, that they're getting hammered as the monetary environment tightens. Now, we've seen this sort of effect with other private companies as well. We spoke about Klarna last week, the buy now, pay later site, which basically just provides people with credit to purchase more goods online. It is now clear that the private markets are not immune to these tough market conditions, so investors need to be wary of that. Now that is pretty much it for corporate news for the day, but we did get something out of Biden's administration which is going to impact the markets for actually probably decades into the future, and it's this news here that Biden wants to curb chipmaker investments into China. Now this is fully expected. I predicted that this would happen over a year ago. China and the US, or really just the East and the West, our relations are getting worse by the day. When I tell you that I think a new Cold War is starting, I doubt you'll really be surprised, but the difference between this Cold War and the last one we had is that we have monumental amounts of trade with our enemies, and that's going to need to change into the future. Supply chains are going to have to change to become more resilient, and the COVID pandemic has proved this more than ever. Now, either companies will do this on their own will because they believe it's in their best interests. We saw this with a company like Peloton, who moved production of their bikes from a factory in Taiwan over to the US to try and become more resilient against the risk of a war in Taiwan. But if companies aren't willing to do it alone, then the governments will force them to do it, and that seems to be what the Biden administration is moving onwards here. Now, this specific news here isn't actually massive, but it is indicative of the direction that this administration is moving in, and the Republicans seem to actually be tougher on trade with China than the Democrats, so I don't see this switching around and stopping being an issue anytime soon. Of course, whether or not this is the right decision for Biden to make is actually pretty irrelevant here. We're not really here to discuss that. We're here to discuss whether or not this will impact the markets and investments, and the simple truth is that it will, because it will raise input costs for companies all over the world. It will cause inflation, it will reduce earnings of companies, and that will affect valuations in the markets. Finally then, I thought I'd just very quickly mention the fact that actually the UK Tory party leadership election is going on and it's starting to progress. We've seen a bunch of candidates culled and we're down to really the last 4, maybe by the time you watch this video, maybe even 3 candidates. So I was wondering if you guys would be a little bit interested in hearing a bit about each candidate from me, maybe their stance on the economy, the direction they're likely to take the economy in, and whether or not that will impact markets in any kind of way. If that does sound interesting, then let me know in the comments down below and I'll be sure to put out a quick video for you all. If you enjoyed this video, then make sure to like, comment and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.